Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to learn about calendar spreads. A calendar spread is an option strategy also known as a time spread because it typically involves the purchase and sale of options contracts with different expiration months. Typically, an option contract with a long-term expiration month is purchased, while an option contract with a near-term expiration month is sold. Note that both contracts share the same underlying security. It is also important to note that this strategy can be implemented using calls or puts. On the other hand, investors' selection of strike prices and expiration months can vary and will be based on their own specific objectives. Calendar spreads can also be referred to as horizontal or diagonal. Horizontal calendar spreads are constructed using options with the same strike price but different expiration months. Investors will typically use this strategy to take advantage of the near-term option's rapid time decay compared to that of the long-term option. This strategy can also be used to exploit the difference in implied volatility between the near-term option and the long-term option. Diagonal calendar spreads involve the purchase of a long-term option contract and the simultaneous sale of a near-term option contract with different strike prices. Typically, the near-term option will have a further out-of-the-money strike price. Investors using diagonal spreads usually expect the underlying security to consolidate during the life cycle of the near-term option. Once the near-term option contract expires, the investor continues to own the long-term option at a reduced cost. The expiration of the near-term option then allows investors to take advantage of their directional bias without any profit limitations. A calendar spread can also be used by investors who have a neutral outlook on a specific security. Under this scenario, the strategy involves the sale of a near-term at-the-money option contract. To limit the risk exposure and benefit from lower margin requirements, a long-term at-the-money option contract would be purchased. If the underlying stock price remains relatively unchanged, the position is typically closed out at the expiration of the near-term option. Let's look at an example where an investor has a neutral outlook. XYZ shares are trading at $60. The investor may purchase a 6-month 60-strike call option for a $5 debit and simultaneously sell a 3-month 60-strike call option for a $3 credit. Notice how both options are at the money. The transaction results in a debit to the account of $2. Remember that a calendar spread may also be established using put options as opposed to call options. Using our example, the trade will be most profitable if the underlying security remains unchanged at the near-term expiration. If that occurs, the near-term option will expire worthless and the investor will keep the premium that was initially collected from its sale. The investor will be left with a long-term option. This position will profit as long as the theta, the rate of time depreciation on the long-term option, does not exceed the premium received from the sale of the short-term option. Note that the long-term option can also be sold. Let's now look at the results in dollar terms. On expiration of the near-term option, the investor will keep the $3 premium. The long-term option may only be worth $3 after 3 months, which corresponds to a loss of $2 that can be attributed to the time depreciation. If the long-term option is sold for $3 and the original debit of $2 is factored in, the investor would have made a $1 profit on the calendar spread. The ideal scenario for the investor is that the underlying stock is slightly below the strike price on expiration. It would allow the investor to let the near-term option expire worthless and to sell the long-term option contract. If the near-term option contract is close to being in the money, the investor may elect to buy it back to avoid assignment. If the stock decreases in value, the investor could consider closing the position for a small loss. While the near-term option may have a high probability of expiring worthless, the long-term option is at risk of further depreciation. The investor could allow the near-term option to expire worthless and continue to hold the long-term option with the expectation of recapturing some of the loss. As an alternative, the investor could also close out the long-term option position, limiting further losses, and hold the remaining short-term option as a naked position, with the expectation of it expiring worthless. It is important to note that the naked position will have a margin requirement and the investor is subject to undefinable risk if the stock reverses and the short option begins to generate an intrinsic value. If the stock increases in value, both the positions will have an intrinsic value. However, the time value component of the option contracts will continue to depreciate. The near-term option will be priced based on the intrinsic value at expiration, while the long-term option will be priced based on its intrinsic value as well as the time premium remaining. Under this scenario, the investor would typically close the entire position at the near-term option expiration. However, the investor may elect to buy back the short option and continue to hold the long option with the expectation of continuing to profit. An investor who has a directional bias on the underlying security may also use calendar spreads. This strategy would also involve the sale of a near-term option and the purchase of a long-term option. The options contract selected will be out of the money in this case. Remember that the objective is to take advantage of a directional move in the underlying. If the outlook is bullish, call options will be used to establish the strategy. On the other hand, if the investor is considered bearish, the strategy will be implemented using put options. Let's now look at an example. Let's assume an investor has a bullish outlook on stock XYZ. In this example, we will assume that XYZ is currently trading at $60. The investor may elect to purchase a 6-month 60-strike call option for a $5 debit and simultaneously sell a 3-month 65-strike call option for a $1.50 credit. The calendar spread is therefore established at a debit of $3.50. Note that in this example, we are using a diagonal calendar spread as the strike prices of the options are different. Also, the sale of the near-term option offsets the cost of the long-term option. When establishing a calendar spread to trade a directional bias, the use of further out-of-the-money option contracts provides a higher probability that the near-term option will expire worthless. The objective is to continue holding on to the long-term option to participate in a continuation in the anticipated direction prior to its expiration. The cost basis of this position is lowered as a result of the near-term option expiring worthless. If the stock remains unchanged at expiration, the near-term option will expire and the investor will continue to hold the long-term option contract. In the event where the investor would like to collect additional premium, the spread can be re-established using the next expiration month. Each month that the investor establishes the spread lowers the cost basis of the trade and as a result lowers the break-even point. If the stock decreases in value, the investor may consider closing the entire position since the long-term option is at risk of further depreciation. The benefit of having sold the near-term option and allowing it to expire is that some of the short-term risk has been hedged. The investor may simply consider holding the long-term option with the expectation of a reversal prior to expiration. Once again, the investor could close out the long-term option, limiting further losses, and hold the remaining short-term option as a naked position, with the expectation of it expiring worthless. If the stock increases in value and both options are in the money at the expiration of the near-term option, the near-term option will be bought back for its intrinsic value, while the long-term option will be sold for both its intrinsic and remaining time value. The investor will also profit from the difference in the spread. If the investor wishes to continue to hold the long-term option, the near-term option can be bought back and the next expiration month sold. If only the long-term option is in the money, the entire position may still be closed for a profit depending on where the underlying security is trading. However, by allowing the near-term option to expire and continuing to hold the long-term option, the investor has unlimited profit potential on the position. As an alternative, the investor may elect to collect additional credit to further offset the cost of the original position by selling a further out-of-the-money option at the next expiration. Let's now look at a reversed calendar spread. In a reversed calendar spread, the long-term option is the one sold and the short-term option is the one purchased, creating a credit as opposed to a debit if we compare with the calendar spread. The investor will use options with the same strike price with different expiration months. This strategy is used to generate income and is typically applied when the investor observes that an option premium is expensive due to high implied volatility. The expectation is that the implied volatility of the options will decrease or that the underlying stock is likely to make a large move away from the strike price. In this example, we will assume that stock XYZ is trading at $50 per share. The investor will write the 6-month 50-strike call for a $3 credit and purchase the 2-month 50-strike call for a debit of $1.10. This results in a net credit of $1.90. Note that the same strategy can be implemented using puts. Let's now look at the role that volatility plays in this example. The vega of the 6-month option contract is greater than the vega of the 2-month option contract. Therefore, a 5% decrease in implied volatility will result in a more significant depreciation in premium for the written long-term option. The 6-month call that was originally written for $3 can now be bought back for $2, resulting in a $1 profit. The 2-month call that was purchased for $1.10 can be sold for 75 cents, losing 35 cents due to the drop in implied volatility. The investor can close the entire position by buying back the written 6-month call and selling the 2-month call for a net debit of $1.25. Having collected $1.90 originally, the investor profits 65 cents. As mentioned, the longer-term option has a higher vega than the shorter-term option. Therefore, the long-term option will lose more value based on a decrease in implied volatility compared to the near-term option. With the drop in implied volatility, the reverse calendar spread may be closed for a small profit. The reverse calendar spread may also profit from a significant move in share value away from the strike price. In this example, we are using call options to illustrate the impact of a $5 decrease in the underlying shares. However, as previously mentioned, the same strategy can be applied using puts, benefiting from a significant move to the upside. For illustrative purposes, we will use the position value at expiration of the near-term option contract. Based on theoretical calculations reflecting a $5 decrease in the underlying shares, the 6-month call option could be bought back for 70 cents. This results in a $2.30 profit for the investor. The 2-month call option will expire worthless, resulting in the full loss of the $1.10 premium. Considering the profit generated from the long-term option written and the loss incurred from the expiration of the near-term option purchased, the investor has kept $1.20 of the initial $1.90 credit collected. Using the previous example, one important consideration is the fact that the long-term option will continue to decrease as the stock value drops. On the other hand, the potential loss of the near-term option is limited to the original premium paid to acquire the contract. Note that the strategy may be closed at expiration of the near-term option for a profit.